My name is Debbie Bannister. I'm with Exchange Resources, and we are going to talk about some of the things that we need to know about the 1031 exchanges from a beginner perspective. And we are going to talk about some things that are affecting us. Like in the end, we're going to talk about the 1031 Tax Reform Act that's out. And we're also going to share just different strategies, especially in this market, what you need to know so that you can help your client have a successful exchange. Okay, so without any further ado, let's get started. Let me back up. Our company's Exchange Resources, and we have a corporate office in San Diego, and I'm out of Mission Viejo. So I'm trying to go back. Here we go. So now let's talk about, before we start anything, I want to separate out the types of properties that IRS has in regards to what qualifies for different tax treatments. So to begin with, as far as IRS is concerned, there's only 3 types of properties in the United States. We have the primary residence, which is what we're going to talk about here. We have a second home, and we have investment property. Of all of them, the investment property is the only one that the 1031 exchange would qualify for. Now, but with the second home and the primary residence, there's different positives and benefits, and we can convert these to investment property or primary. And we're going to talk about that. And then we'll sort out these properties, and then we'll focus only on investment. So to begin with, for primary residence, the tax code specifies the number in the code is 121. And that is if you owned and lived in the property for 2 years consecutively, or 2 out of the last 5 years, then the homeowner qualifies, if they're married, to be protected of $500,000 of gain. And if you're single, up to $250,000 of gain. And that's tax-free, the best tax deal in town. If things don't change in Congress, this is amazing. So if there's any gain over that, for example, if you're married and you have a $700,000 gain, then you pay taxes on $200,000, but the first $500,000 is tax-free. So that's this is the primary residence exclusion. Now, when somebody owns, before we start talking about the withholding here, when somebody owns a primary residence, and let's say that they have a gain of $1 million. If they, in the last 5 years, it says they have to own and use it 2 years. So say they've owned that property for 30 years. So you're 29 and 30 in the last 5 years, it's been a primary. If they rent it out for 1 to 2 years, then and sell it before the 5th year is up, and this is important, this time frame, if they sell it before the 5th year is up, then they get the privilege, and no, you can't get it on any other type of deal, of using both the primary residence exclusion and the 1031 exchange. And how that works is the first 500 of that $1 million gain is tax-free, and the client can put that, close escrow, put that money in their pocket, no problem. The last 500, they can do a 1031 exchange with that, as long as they bought equal or greater to that 500, then they successfully were able to defer and get tax-free dollars and defer the rest of the taxes on the last 500 and use that to buy investment property. So just throwing that out there, that's just a neat tool, a neat thing to know that a client can do, especially with these primary residents. They've owned them forever. Their life has changed. Maybe they went from a marriage status to a single status because of divorce or death. And this gives them an opportunity to be able to use this gain, to be able to get that gain with least amount of taxation. Now, when it comes to a second home, and we're going to talk about that in a few minutes more, a second home, if the property is truly used as a second home, they pay the capital gains tax. So on a second home and investment property, if you're paying the tax, then this screen is very important to understand. That California has a withholding. It's not a separate tax, it's not an additional tax. It's a prepayment of what the state tax would be on that sale. So escrow, this withholding, this prepayment is 3.33% of the sales price. Okay, or it could be the actual, they can use a 593 form, and there's a portion on the form, I think in section 6, that gives a little breakdown of a mini profit and loss statement. They can fill that out, have their CPA fill that out, and figure out exactly what the taxes would be. And then they would pay 12.3, which is what the tax rate would be at the close of escrow. So 3.3 of the sales price or 12.3 of the actual gain. The client gets to choose what they'd like to do, but that has to be paid at the close of escrow. Now, they would do this, but if they did the following, they wouldn't have to worry about the withholding. Did a successful 1031 exchange. If there was a loss on the property and there was no gain, there's no withholding. And if a corporation, including an LLC, a bank or insurance company owns that property, then there, excuse me, then there is no withholding on that property. So if somebody was selling investment property and they successfully completed a 1031 exchange, then they would have no withholding and they would be able to use all that money that came out as gain for finding more replacement property. Now, as far as IRS is concerned, if you did an exchange, but there was money left over and you didn't spend all your money, it would be still a very successful exchange. That's no problem. Just that money that was left over would be called cash boot. And that cash boot is a word that IRS uses to indicate a taxable event. Then they would just pay money, do the withholding on that extra money left over. So an example, let's say that they had $100,000 left over. They didn't spend all their money in their exchange. Their exchange is beautiful. They pay taxes on that 100,000, and on that 100,000, 3 1/3 withholding would be taken out of it. Also, if there was a note that was carried back, then the value of that note would be subject to a withholding. If the exchange fails, after they closed escrow and then the exchange fails, then the withholding would be happen with the exchange company. After the failure of the exchange, then the withholding would be paid and the client's proceeds would be returned to them. Okay, so let's answer this question real quick. What is a 1031 exchange? Let's see here. And sometimes this confuses people because of the language the tax code uses, but it's basically this. It's basically a trade. It's where you take the property you want to sell, and you're basically on all the economic factors that are involved with that property, the value of the property, the loan debt, the cash position, everything that encompasses that property. You're taking that and you're exchanging or trading for different property. So you can do this with just one replacement property, or you can buy several properties, and cumulatively, as long as they add up equal or greater to what they sold for, then they would totally defer their taxable event. So remember, an exchange is basically a trade. You're selling one to replace it with another. And it doesn't have to just be one property. It can be several properties, and it's a total value of what you're selling that works. Okay. It's obvious, why are people doing them? When it comes to 1031 exchange, people think that the benefit and why people do them is all about not paying the tax. And that has a benefit, but really the benefit is, by not paying that tax, what can you do with that money? So let's talk about what that tax would be. So there's certain layers of taxation currently that the taxpayer would be paying tax on if they sold investment property and did not do an exchange. So we have the federal tax, which is if they own this property for a year or less, then that federal tax would be their tax bracket. It would be considered ordinary income. If they own that property for a year and a day more, then it's not ordinary income anymore. It's referred to as long-term capital gains. And if the taxpayer's income is $400,000 or less, then that tax rate is 15%. If it's $401,000 and more, then that tax rate is 20%. So that's federal. Then we have the state of California. The state of California has a flat rate of 12.3, and that's as high as it could be. For some income earners, it can be as low as 9.3. But I always quote 12.3 so that people aren't shocked in case it is higher than what they expected. So that's where it caps out. So you have federal, 15%, let's go with. Then you have 12.3. So that's federal and state. Then there's a whole different type of taxation. This is called recapturing the depreciation. And what that means is that they will total depreciation that's taken on that property for the life of it as an investment property gets added up. So let's say my property's been an investment property for 20 years. I depreciated it for $300,000 totally in 20 years. So then that total of $300,000, as it gets tallied up, then I pay back, which is called recapturing the depreciation. I pay back 25% of that 300,000. So that would be $75,000. That's a separate tax bill that the feds want. So we have Fed state recapture. Then we have what the Medicare plan. If their passive income is over, if you're single, 200,000, and that's the gain from this property and any other passive income they may have in their life for that year, add it all together, and anything over, if they're single, 200,000, every dollar after the 200,000 they pay a separate 3.8%. If they're married, that threshold is 250, and then every dollar after the 250 they pay that 3.8%. So we have Fed, state, recapture depreciation, and that extra Medicare tax. So as you can see, there's a lot of money that goes out of the door when someone does not do an exchange, if they pay those capital gains taxes. And so with that in mind, this next slide really shows us what you can do with that money instead of paying it to the government. So people utilize the 1031 exchange and they find it to be extreme benefit because the exchange helps them to increase their wealth. They increase their real estate holdings. They're able to change things around. Like if, say, you bought an investment property and it's not performing like you had thought, then you can sell it and exchange it without taking that tax hit and improve that tax portfolio. I mean, that real estate portfolio that you have, so you can improve it. Now, let's see here. People also want to change the type of properties they have. So maybe they have commercial and it's not working for them, like with this downturn with COVID. Or maybe they have apartment complexes and the neighborhood has changed, or whatever it may be. They don't have to hold on to that asset if it's not performing for them. So they can sell it, they can change it and exchange into something else that works. People utilize the exchange when they move. They want to have their property by them. So they do the 1031 exchange, and they do it for estate planning also. So when it comes to estate planning, the way the rules and the tax code currently is, if the property is held in a family trust, then the beneficiaries of that trust will inherit that property, and they get what IRS refers to as a stepped up in basis. So what that means is at the time of death, the value of that property gets determined. So let's say I bought a property for $50,000 in 1970, and now it's worth $1 million. So I've died. My heirs get the value of that property at my death, which is $1 million. So the stepped up in basis means that they don't have to inherit it at what I bought it for. So they get a value, and this is their basis, this $1 million. So now if they sell it at that $1 million, they pay no taxes and they get the $1 million tax free. If they hold on to it and now it's worth 1.5 million, then and they sell it, then they only pay taxes on the 500, the value that increased from that 1 million. So people use 1031 exchanges for this estate planning and this benefit of the stepped up in basis. So they may have, the taxpayer that owns these properties may be older. They're trying to get things ready for their heirs to inherit. I had a client that did this years ago, and she had really, really bad dog apartment complexes in Buena Park. She didn't want to put any more money in them. She didn't want her heirs to be stuck with a money pit. So she ended up selling them. And she had 3 grown kids. And she told each of them, I have 3 apartment complexes. So each one of them had one, and they were all about the same value. So she told kid A, what you can do, I'm going to be the owner, I'm going to sell, and I'm going to buy, and I'm going to own this property. But I will pay you fair market value as property manager. So I want you to pick a property that I'm going to buy as my replacement property in my exchange that you want to manage, you can take care of, and you want to obtain through when I die. This is what you're going to inherit. So she did that with all 3 of her kids, and they all chose the properties they wanted to inherit. They all ended up with really good properties. And then 6 months later, after everything settled, she ended up dying. And it was really sad, but it took her a year and a half to go through this whole process. But in the end, her heirs actually, they were able to inherit what they wanted. They got to choose the replacement property that the mom bought. And they knew what they were inheriting. They knew the problems they were going to get. So it worked out to be quite amazing. And some of them sold with that stepped up in basis and had all this tax-free money. Others kept. So it just gave their heirs a lot of choices. And that just shows you what you can do. One of the benefits of the 1031. Now, there's lots of things in the 1031 world. Oops, I went too far. Here we go. There we go. There's some things that we think it should apply to the 1031 exchange, but they don't. So let me share with you with things that you cannot do an exchange with. And one is stocks and bonds. So there's certain real estate transactions, maybe co-ops, or certain ones, not all of them, but that or REIT, and a traditional REIT, that the evidence of ownership is a stock certificate, not a deed of trust. Those types of real estate do not qualify for a 1031 exchange. So 1031 exchange only works for real property. So stocks and bonds do not qualify. Stocks in a trade don't qualify. That would be like inventory if you're selling a business. Partnership interests, like if I was a partner in a corporation and I had 3 other partners, so there's 4 of us in a corporation. We're all members of this. And we buy real estate with this corporation, and the corporation owns it. The owner is the corporation, not me. So even if I bought out the interest of my partner, doesn't mean that I can't do an exchange on that. I cannot, because I'm buying into a business, not the real estate. So that's the other thing that we need to realize. The next can affect us, and that's mortgages and promissory notes. So if you have a client that wants to do a 1031 exchange and they want to carry back paper for a note for their buyer, they need to talk to their tax person because notes are not exchangeable. So if I sold something for $500,000, I own it free and clear. I carry back a note for $100,000 for my buyers, a private money. Then that means the $100,000 would be separated out, and I would do my exchange on the $400,000. And then when that note became due and payable, whatever part of that note represents a taxable event, I would pay taxes on. So notes are not exchangeable. And the other thing that affects us in our real estate is flipping. So in a 1031 exchange, it does not qualify for properties that are intended to be bought, fixed, and flipped. So IRS looks at that as those as dealers that do that. And the houses are basically inventory. They're not exchangeable, and this is their business. So remember that. If you have a client that wants to do an exchange and their business is flipping, so they just want to buy it, sell it, fix it, sell it, they don't qualify. So it's important to know. I get a lot of calls on that, unfortunately. Okay, so remember in the beginning, we talked about the 3 different types of real estate: the primary, the second home, and investment. Now, as I mentioned earlier, the second homes do not qualify for a 1031 exchange if they sell it, if they're used truly as a second home for the benefit of you and your family. But a property can be converted or a property may already qualify and they don't know. So let me explain the criteria of what IRS has put together in regards to what qualifies for 1030 in regards to an investment property. So IRS says a property can be, for it to qualify as investment property, it needs to be rented out minimally 2 weeks a year. So that's not bad. So you get that minimally 2 weeks a year, but it cannot be used more than 2 weeks a year. So it's got to be rented out minimally 2 weeks a year, cannot be used personally more than 2 weeks a year. Or if you rent it out more, you can use it personally 10% of the time rented, you get whatever's greater. So if I do VBRO and I rent to 300 days a year, then that means I can 10% of the time rent it. I can use that property 30 days. And by using it for 30 days, I do not change that this is investment property. It still qualifies as investment property. I just can't use it more than that. So I get 30 days a year. So again, 10% of the time rented, 2 weeks or 10% of the time rented is personal use. And if you stick to that criteria, then it does qualify as investment property, and they can do an exchange. But the biggest question I get is some people will rent a house like they have in the desert. They rent that 6 months a year and they use it 6 months in a year. So if you look at it that way, it doesn't fit that model of time that IRS gives them. It's more, they're using it more than 10% of the time rented. So even though they rent it out and get good income for 6 months, it's still a second home. What else is another type of property, use of a property that qualifies it as a second home and not investment property, is if you bought the property for your parents or your son or your daughter or some other family relative that's using it and they're not paying rent, then it would be a second home. Okay. Now, what we're going to do is talk about the different types of exchanges. Let's see here. Let me get this done right. There we go. And in the exchange world, there are a few different things that we do that are different tools, if you will, for 1031 exchanges. The most common exchange tool that we see is what's called the delayed exchange. And the delayed exchange is, exchanges can be difficult, but the delay causes a lot of heartache, even though it was given as like a benefit from IRS because of the time frames. And we're going to talk about that in a few minutes in greater detail. The simultaneous exchange is when the sale and the purchase, they all close together. Now, it used to be in the 80s, up to late 80s, used to be that all exchanges had to be simultaneous. And that was difficult, trying to get everything coordinated where the sale and the purchase closed like within a day of each other. But when the delayed exchange was introduced to the tax code, which was the late 80s, then that took that strain away. So now we had an option, simultaneous or using the time frame that we're going to talk about. The next type of an exchange is a little bit more, it's a more difficult exchange. It's called a build-to-suit or an improvement exchange. And that is when a taxpayer, say they buy less, say they sold for 500 cash, they found something and they bought it for 400,000, they can use that last 100,000 to improve the property. And we'll talk about that later. And then there's also the final exchange is called the reverse exchange. And we're going to talk about that later, where you can buy first. In the market the way it is now, it really has become a very successful tool. And then you have 180 days to sell. So those are some tools in the exchange world, and we're going to talk about each of those individually. Okay. And if anybody has any questions that's pertinent to what we're talking about right now, then so I did not get it automatically. Okay. So if anybody has questions, you can put them in the chat and I answer and entertain those questions. But if it's not pertinent to what we're talking about at the moment, then I will probably just say that I'm going to be addressing that in just a few minutes. So I won't answer it immediately. Now, there is a question here. It says, does the estate tax pay any taxes for the stepped up in basis? Can an owner in their primary residence to a rental? Okay, so let's answer those two questions first because they're really pertinent to what we just talked about. The first question is about the stepped up in basis. And it says, does the state tax pay any taxes for stepped up in basis? No. This is a beautiful tool that's been given. Of course, you need to always talk to your state attorney and your CPA in the event of a death. So if it's set up in a family trust properly, then there would be no estate tax. There's a certain limit that they have for each that would be under a threshold. I think it's like 11,000 per person. And I'm a little rusty on that. So as long as $11 million per person, as long as that valuation of what they inherit is under that threshold, then there would be no estate tax. So, but I will refresh my memory on exactly that dollar amount. I thought I have 11 million in my head. I might be wrong, but that gives you the concept. Now, can an owner change their primary residence to a rental property to take advantage of an exchange? Absolutely. So what would happen, remember when we talked about in the last 5 years dictates what the taxpayer qualifies for or doesn't qualify for in regards to tax treatments. So if they have a primary residence, like we mentioned, and they lived there for 2 years and they rented it out for 2 years, and they sold it before the 5th year, it would still be considered a primary, even though the last use was a rental, because in the last 5 years, they still had 2 years of living in it and owning it. So that still would be considered a primary. But if they lived in it for a long time and then they rented it out, and say they rented it out for 3 years, now when they sell it, they'll be in the 6th year. So they're past that 5 years. It is now it converts to investment property and it's not a primary any longer. So I hope that helps. And another question is, can a seller sell property for $500K and buy replacement property for $1.5 million? Absolutely, they can. They can sell and buy for as high as they can afford, and there is no limit. And we're going to talk a little bit. There's some limits in regards to how we identify, and we'll talk about that in a few minutes. But if they just sell one to buy one, there's no limit. Okay, so I'm going to go on now. Now, what we're going to talk about next are the things in a listing appointment. So let's put ourselves back. This is what, let me back up. When it comes to 1031 exchange and you're working with an investor, I think what's really important is for you what are the things that you need to know in assisting the client? And we're going to talk about that because the code can go on and on and on and on. We don't care about all that. And we're going to focus and narrow it down and see exactly what you need to really think about. So when you're on that listing appointment, you want to really pay attention to who's the actual seller. Is it in a family trust? Is it a husband and wife as community property? Is it in an LLC or some sort of corporation? If it's in an LLC, what's important is you want to find out who are the members of this LLC. If it's just the husband and wife, then it won't be difficult. But if there's other people that are members, then what they need to understand is that the LLC is the taxpayer. So the LLC will be selling this property and the LLC will be buying. And I can meet with you guys individually and we can talk more about that and figure out what would be the right tool. When it gets complicated is you have an LLC and say there's 4 parties and 2 of them want to exchange, but 2 of them want to get out. That LLC is the taxpayer. So separating out will not work and it needs a little bit of strategies. So that I welcome you. If you have any clients that need help like that, this listing appointment is when we've got to really talk about these things. So if that comes up, feel free to call me. The next thing that you want to pay attention to, or the next thing I think is really important, is in your conversation, If they don't say anything about doing a 1031 exchange, because you know it's investment property, then ask them one simple question. What do you plan to do with the proceeds from the sale of this property? If they say, I want to buy more real estate, then this is by hands down, then this qualifies for a 1031. They want to buy more real estate to use for rental properties. So that's pretty plain. If they say, I'm done, I don't want to own any more investment property, I don't care, I'm just going to pay the tax. So they're saying that now, don't believe them. Make them, as part of a homework assignment, go and talk to their CPA, give them the listing price, a guesstimated amount of fees, and then for selling the property, and make them talk to their CPA so that they can find out what that taxable event, a good guesstimate of what that taxable event would be if they did not do an exchange. Now you're giving them reality, you're giving them facts that they can analyze. And if they can't stomach paying that number, that amount of money in taxes, then they'll realize a 1031 may be the tool for them. And other people see that number and they can stomach it. They're okay with paying the tax. But I have to say, in my career of doing exchanges, which is going into my 22nd year now, I've talked to more upset taxpayers than I can tell you that I have nothing to do with their transaction, but they told the real estate agent, I'm paying the tax, I don't care how much it is, I don't want any more investment property. So they make this bold statement, they're adamant, but of course you're going to believe them for as adamant as they are. Now, 6 months later, so I'm not even involved in this because they didn't do an exchange, but now they've had their taxes done. So they're calling me, and I've had more grown men cry on the phone because they couldn't stomach paying that amount of tax. So the point, and so I have to tell them, now it's on my lap where I have to share with them that there's nothing they can do. It's too late. They want to exchange now when it's too late. So the point is, if they say they want to pay the tax, they just want out, we respectfully understand, but make them talk to their tax person so they can make an educated decision and not just an emotional whim, because those emotional whims, they find out later that the result of that, the taxes that could result, may be more than they want to pay. So that's very important. Okay, so now let's go on to the next slide here. Oh, there we go. So let's talk about, so now we know the person is going to exchange. So let's talk about what they need to buy for, because this gets confusing for a lot of people. I have clients that call me up and they think they just pay, they're going to buy for whatever their actual gain is. So they own a property and it's worth $2 million, but their gain is only 500,000. So they think all they have to do is buy equal or greater to 500. Other people think that they only have to pay the proceeds. They only have to take the proceeds that come out of the sale escrow. So say they have a $2 million sale, they have $1 million loan, and they get, and that's after tax, after fees, $1 million net. They have $1 million loan and they get $1 million cash. So in that scenario, some people think it's all about just spending the cash. And that's not actually true. So let's talk about what is required. So the tax code specifies that they need to buy equal or greater than what the property is sold for, and that is after the cost of sale. So let's do a simple example. Let's say they sold for $540,000. It cost them $40,000 for commission, escrow, title, recording fees, inspections, maybe work as a result of inspections. Those are all the non-recurring fees, the one-time fees related to the sale. Those fees can be deducted off the top. So in my situation, I say I sold for 540. Let's say all those fees added up to 40K. So now my net sales price is 500. That basically is the number I need to buy equal or greater to. But that 500 has a loan in there for 200,000. So that means I'm going to have $300,000 proceeds. So what IRS requires, as we can see in the second bullet point, that we need to take on the same amount of debt on what we're buying than what we sold. So I have a $200,000 loan on what I sold. So the only way I can buy equal or greater to that net sales price of 500,000 is I use my 300,000 down cash as down payment. I get a new loan for 200,000. That means I bought for 500,000, but I replaced that loan debt of 200 and used my cash as a down payment. What's very, very important to understand is that in a 1031 exchange, if the debt is not replaced, then the taxpayer will pay capital gains tax on every dollar of loan debt that's not replaced. So if I took that 300,000 in my example, I took that 300,000 and I thought that's all I need to spend to have an exchange. So I buy something for 300, I'm going to pay capital gains tax on 200K of what I don't replace of loan debt. Now, remember earlier we talked about boot, the term boot. So we have loan cash boot, so any money left over you pay taxes on, and we have debt boot, so any loan debt that's not replaced we pay taxes on. Now, loan debt, I say use the term replace, and there's two ways you can replace loan debt. One way is by getting new financing on whatever I'm buying, just getting a new loan, no problem. But maybe my loan debt was only 100,000 and it was low, and I have resources, I have cash. So I can replace loan debt with my own cash, and that qualifies too. So I buy something for 500. I use my, say I have $100,000 loan debt. I use my $400,000 cash from my sale, and that is the down payment. And then, I mean, that's, for the purchase. And then I bring into escrow another $100,000 of my own money. That $100,000 of my own money just replaced that loan debt. And now I don't have to have a loan because I used new cash to replace that loan debt that I needed to replace. So I can use my own money or get a new loan. Those are my options. I'm replacing loan debt. And just remember, any cash left over is taxable. Any loan debt that's not replaced is taxable. So that's our formula for what we need to buy. Okay. Let's see if there's here at this point, see if there's any more questions. Okay. Boot, the question is, what is boot? Boot is a tax term that's used in the code that represents a taxable event. So if like I said, if I have money left over, I was needed to buy equal or greater to 500,000, but I had 50,000 left over. I only bought for 450. Then that 50,000 is called boot. It's called cash boot, and I'm going to pay taxes on that. And again, my exchange is perfect. I didn't hurt my exchange in any way by not spending all that money. I just pay taxes on the difference. I hope that helps. Okay, so now the question is, how long do I have to do my exchange? So what's important is, now we talked about the economic factors and that's gone. So what's important now is we're going to focus on timeframes. Remember, in the delayed exchange, it's all about doing this within the prescribed timeframes that IRS gives us so that the exchange can be done successfully. So there's two clocks and they run simultaneous with each other. So you have that run simultaneous with each other. The second clock, we're going to start backwards and work forwards, is a total of 180 days. And that starts the day after escrow closes. So we get a total of 180 days the day after escrow closes. And this is called my exchange period. And I need to buy, close escrow, and be done in that time. And what makes this, this clock is long because there's a few things that can be done with it. So for example, you may buy new construction. Okay, first of all, is the session being recorded, please? I missed the first half. Can we make sure the session is recorded, Elsie? Okay. So we have people need sometimes that 180 days because they may be buying multiple properties and you have all these closing dates. or maybe they're buying new construction, and the construction will be a few months. As long as that property it can close escrow by that 180th day, it will work. So that's why we have a long clock like that. Now it says 180 days or. So the or is April 15th, whatever comes first. So the only time this really comes to play in every given year is approximately October 20th, right around that neighborhood, because from October 20th to December 31st, there's not a 180 days. There may be 179 days. You don't have a whole 180 days. Or excuse me, not to, yeah, to accomplish your exchange. Excuse me, let me back that up. I'm talking erroneously here. From October 20th to April 15th, not December 30th, not January 1st, but April 15th. You're not going to have 180 days. So if anything after October 20, right in that neighborhood, if you need the whole 180 days, because April 15th will come before the 180th day. So if you need that whole 180 days, it's essential for the taxpayer who's doing the exchange to file for an extension. And that extension will allow them to complete their exchange period. It doesn't give them extra time. It just allows them to complete their exchange. And when they're done with their exchange, then they can file their tax return. If they file their tax return and they're not complete, their exchange is not done, then they just disqualify themselves from their exchange. So this is very important. So we make sure during that time of year, we babysit our clients and we make sure they understand that if they need that extra time, they have to file for an extension. Okay, now that's the first clock. Remember, I talked about 2 clocks. So we have our exchange period of 180 days. Now the first 45 days of that 180 is separated out for the sake of identifying property or properties that they will buy. So they only have 45 days. Now, please understand, in these time frames, we're going to talk about these rules. In these time frames that they have, the 45 and the 180, there are no extensions for personal use. So if you identified a property, let's back up. If you identified a property and day 50, the 45 days have passed, and now we're in day 50, and they cannot purchase that property for any reason, the exchange is disqualified. If they identify and the property falls apart inside the 45 days, so say day 15, it didn't work, then they can revoke and re-identify as much as they need until midnight of that 45th day. Midnight of that 45th day, the exchange, if they can't buy what's on that sheet, the exchange will be disqualified, or if they did not identify. So the identification is essential to a successful exchange. What's really important, in my opinion, is strategy here. If possible, and I know I'm not saying push the envelope, but if possible, when you're representing the seller on the list, the property you're listing, and you start entertaining offers, if somebody has an offer and they want a 20-day escrow, can you push it to 30 days? Is there any way to eke, or if they have a 30-day escrow, can you push it to 45? If there's any way just to eke a little bit more time, what you're doing, and it may not be possible, but if it's possible, what you're accomplishing is you're buying your client, the taxpayer that's doing the exchange, a little extra time up front before the clock starts ticking. So this time up front can be a lifesaver, because you guys can be out there, they can be presenting offers on things they want to buy. If an offer gets accepted and you get the inspections done, then maybe you can even close the replacement property before the 45th day passes. And if you can do that, then you have just helped your client have a successful exchange, and there's no chance of it falling apart. But use any time, even if it's a little bit of time, whatever time up front is the time to be working with them, trying to find replacement property, presenting offers, see what you can accomplish. Because even if you don't get an offer accepted in the 45 days have started, you didn't waste the first 15, 20 days of that 45 days and with nothing. At least that was bonus time that you weren't able to find something. So that, just think about just a little bit longer escrow, because you're buying your client some time. And there are other tools too. For example, you can negotiate an extension to the close of escrow if everybody's willing. But these are things that I wouldn't push the envelope. But if you able to accomplish that, then you negotiate that up front. There's no surprises. And if they need that extension that was negotiated, maybe it's 15 days, then they can use that at the closing and use that, opt to use that extension for that 15 days. So there's different tools, and some of them can work and some of them may not work, but it's nice to know what those tools are in regards to trying to help your client so that they can find a replacement property. Now, remember I said there's no extensions to these timeframes. Before I go on, I just want to mention that the only time there is an extension that would be issued is if there was a national disaster that was declared by the president and FEMA was used to aid the disaster victims. So those are the two ingredients that need to be. And if that happens, then IRS will issue an extension. And usually that extension is about 120, 25 days, something like that, to the transaction. And so I just want to let you know, if it's on a federal, national level, then an extension will be honored. Any personal use, any personal reasons, horrible things like death, different things that may happen, maybe the property burned down, there's no extensions. Okay. Now, let's talk about, let me check this chat room. There's a couple more questions here before I go on. Okay, I think that's it. Perfect. Okay, so let's go to talking about the identification. So there's two ways to identify property. So this goes back to that question in the beginning that was asked. Is there a limit to how much a person can buy in a 1031 exchange? Using this rule, there's no limit. And this rule is this: you can identify 1, 2 to 3 with a maximum of 3 properties. As long as, and those properties, whatever, each of those properties, as long as they're equal or greater, then they will, if they just bought one, they will defer the capital gains event for that sale. So if I sold for 500 net, like I used in that example, but now I'm buying for 1.5, that's perfect. And I'm just buying one property, I can buy as high as I can afford. Other people may want to buy 2 or 3 properties, and accumulatively together, they add up to my whatever. So if I sold for 500 and I'm going out of state, I bought 2 properties, now each of them for around 250 each. Now I've just bought 2 properties, and accumulatively they add equal or greater to my net sales price. So this is the first rule. And this is the most common rule for identification, because in Orange County, California, wherever, values are what they are, and you're not necessarily going to sell one property and buy 3 here. If the value was extremely high, then that makes sense. But for most people, they may sell one single family investment property and they just want to replace it with another single family investment. So that 3 property rule is totally the rule that they would use. Now, what about those people who want to buy more than 3 properties? This rule really works when you're selling a larger valued asset. So for example, I had a gentleman, a client, that sold farmland in Northern California, Sacramento area. And the farmland was worth about $18 million. And he wanted to take that $18 million and buy real estate everywhere. He just wanted to go on a total buying spree. So he used the 200% rule. So what happens is you can take your sales price, like this 18 million of this client, We doubled it, hence the 200%. So that would be now 36 million. And so now he can identify as many properties as he chooses, but each property that goes on that ID sheet has a value, either the listing value, if that's all you have at that point, but every property has a value. So you would put as many properties as you can, then you have to add up or tally up all those values. As long as it did not exceed that doubled amount, like in my example, 36 million, then you have a perfect identification. So you can identify for less, but you just cannot exceed. So for in real life, let's just say they sold for 2 million. Now they can double it and they have 4 million. Doesn't mean they have to buy for 4 million, but it gives them a cushion. So maybe they just want to buy 1 or 2 properties, but they want to use the 200% rule to have more properties on there as options to buy. So that's what the 200%. It's about the math. It's not about having to buy too greater. And this is a good example. They sold for 550, doubled it. So you got 1.1. They put 4 properties here, got them more than 3. Each property has a value, and the total, they add up totally to 1.1. So they did not exceed their doubled sales price. Okay. Now, let me check before I go into the next category, let's check questions. It says, so there's no limit on the number of properties they can buy on the 200% rule. Faye, that's absolutely true. The only thing that limits them is they just cannot go over that doubled value. So some people will identify, like a $36 million person, he identified sheets of property and all those sheets added up to under 36. He probably went to 34 or something, but that was beautiful. So there's no limit in regards to how many properties. You just got to make sure you stay within that 200% value. Okay, let's see here. Oh, there's one more question. I'll go back. That was asked by Mary. In order to take advantage of the $500,000 for the married seller's tax advantage, do both spouses need to be entitled? So let's go back. That was with the primary residence exclusion, the 121. Yes, the tax code says you have to own the property and you have to use it 2 years minimally, or 2 years out of the last 5 years. So you have to be entitled to own it. So if you have a husband, wife, and one is just entitled and the other isn't, for whatever reason, then it's going to be 250. So that you would always want to make sure that both parties, or whoever, maybe there's 2 other people, not husband, wife, but just 2 people entitled, they each get their 250. But just because a person lives there doesn't mean that they automatically qualify. Because the rules are you have to own it, you have to use it. Okay, let's go back now. Let's go back to the next thing that we want to talk about, and that is what the tax code refers to a qualified exchange being like kind. And everybody has, the clients I talk to, they call me with their own interpretation of what like kind is per the tax code. Some people think that if they're selling commercial, they're stuck with commercial because that's like kind, a warehouse for a warehouse. Or they feel like if I'm selling single family residence, I'm stuck to a single family residence. I can't go commercial. I can't do something different. And that is not true. So this is really cool because the reality is you can sell a commercial building and buy ranch land, vacant land. IRS puts vacant land in investment category. So you can sell vacant land and buy residential single family property for investment, for a rental. You can take rental properties and maybe buy an easement. But the thing we want to realize is there's a limit, like leasehold properties, as long as there's 30 years or more left on that lease, maybe even counting options left on that lease, then that's considered from IRS's perspective as real property. If the lease is under 30 years, it does not qualify. So we want real property, and it doesn't matter the type of real property, as long as it's what IRS looks for is the use. So whatever you sell, for it to qualify for a 1031 exchange, must be investment property or property used for the productive use of a trade or a business. So you take that property and you buy something else, and it needs to be used as a rental property or for the productive use of a trade or a business. So that means you can have your own, you can buy a property and have your own business operate out of it, and it still qualifies for 1031 exchange. And our limits are, we can do this anywhere in the US, domestic for domestic or foreign for foreign, but you can't cross. So you can't sell Mexican property in Mexico and buy something in California. You can do foreign exchange for Mexico for Costa Rica or something like that, foreign for foreign, and only domestic property for domestic property. Okay. Now, like we talked about when regarding earlier, we talked about the different types of exchanges. And the one that popped up was simultaneous exchange. And the reason why we want to talk about this is because some taxpayers believe, or they really feel, that since in a 1031 exchange, since money is going directly from one sale to the other sale, one from the sale to the purchase, excuse me, and they're not touching those funds, then they don't need to do a 1031 exchange. And what happened is in the early 90s, there was a gentleman by the name of Mr. Gray, and he had that same thinking. He thought, well, I'm not touching the money, so there's no reason why I can't do this 1031 exchange, but I don't need to use a qualified intermediary. And IRS audited him. He lost his audit, and they fought for several years, and then ended up with the tax commissioner. The tax commissioner in the tax world is equivalent to the Supreme Court in federal court. So the tax commissioner heard the case, and the ruling on this was as follows. His exchange was disqualified because even though he did not actually receive those proceeds himself, it didn't come to his bank account, excuse me, then, but he had control of those proceeds by directing where the money would be going. So this was a very important issue, because when it comes to 1031 exchanges, it helps people understand how the structure should be set up. So IRS created a category called qualified intermediaries, companies that do exchanges. That's the name that IRS gives us. We're qualified intermediary. According to the tax code, when somebody does a 1031 exchange, they cannot do it by themselves. They have to use this third party, a qualified intermediary. And what this qualified intermediary does is it relieves the client from having that constructive receipt or control of those proceeds. So all the control falls back on the qualified intermediary. So what happens is, in this situation, the exchange company would give the instruction to the escrow A for the sale property to forward those proceeds directly to escrow B. So then the instruction came from the exchange company or the qualified intermediary and not the client. So this is important at this point. I wanted just to bring up the structure. So when someone's doing a 1031 exchange and they, you know that they're doing it, then it's very, very important in the sale escrow process that an exchange officially becomes opened inside that sale escrow. So when you have a listing, some people think they need to mention that it's a 1031 exchange, and you do whatever you need to do. But from a tax code perspective, on the listing, it doesn't have to be referenced. But when you do go into contract, when it's time, when an offer is accepted, and you're in you accept an offer for the client, when the client accepts an offer, then there's verbiage that really needs to go into contract at that point. And that verbiage basically is this. It states that the seller is doing a 1031 exchange, which will not delay the transaction or cost the buyer anything because of the seller's exchange. So it's not going to cost the seller anything or delay the transaction. And that's why if there's any extensions to timeframes, it's real important to negotiate that up front. And whatever's accepted, then you go according to whatever's been accepted. So there's no last minute begging. You try to get everything figured out up front. So the verbiage goes into the contract. And what this verbiage does is it opens the door now for the qualified intermediary, a company like us, to actually then come into the transaction and work in behalf of the seller. So the door has been opened. And it also gives a disclosure to the buyers that the seller's doing this exchange. And it's really important because there's some transitional changes that will happen due to the exchange that the buyer may frighten them if they didn't understand that this is what's happening. So what are those changes? First of all, when a client is doing an exchange, like we said, since the tax code references that they can't have control of those proceeds, and the qualified intermediary will be working in their behalf in that regard, we create an exchange agreement. And in this exchange agreement, there's a section that's an assignment of rights. And what that means is we get assigned into the transaction with the seller. So if I'm the seller, Debbie Bannister, my exchange company the seller's line in escrow, the signature line would show exchange resources being the qualified intermediary, FOB, the acronym, which is for the benefit of Debbie Bannister. So now exchange resources and Debbie Bannister are both sellers. And so what happens is that at the close of that sale, then those proceeds legally can come to us because we're party of that transaction. For the sake of the exchange, escrow closes, those proceeds come to us as a qualified intermediary, and they're held in a segregated account, waiting to be spent on what they're buying. So we're assigned into the transaction, we join them as a buyer, as a seller. Now, when they're buying replacement property, the same thing comes through. We join them as a buyer. The verbiage in the contract was the same, that now the seller understands that their buyer's doing an exchange. So now we're helping them understand there may be some transitional changes. The transitional changes in the contract is that now the buyer's not just Debbie Bannister, but the buyer's exchange resources for the benefit of Debbie Bannister. And now what that allows us to do legally is when it's time to start providing the funds for closing, now legally that money can come to this escrow because we're part of that transaction and can be wired to escrow so that property can be purchased and closed. So you see there's paperwork and things that need to take place. So when someone's doing an exchange, they start with the verbiage in the contract. Then when escrow's opened, then they would contact the qualified intermediary and let them know that they need to do an exchange. The qualified intermediary will then ask for some information. They're talking, first of all, they want to make sure the taxpayer understands. Like if it's me, I want to make sure the taxpayer understands what they're about to do and answer all their questions and give them some guidance. Then the agreement is set up, the exchange agreement, which assigns us into the transaction. And this has to be all taken care of before escrow closes on what they're buying. If escrow closes, on what they're selling. If escrow closes, then and they haven't set this up, it's too late. So they only have that escrow period to get this taken care of. So this helps us to appreciate with the simultaneous exchange, how we started this whole discussion, helps us to appreciate that if it's structured right, using a qualified intermediary, that would be totally in compliance with the tax code. So now the qualified intermediary gives the instructions to escrow what to do with those proceeds. Okay, so that's just a little breakdown on what we do in the transaction. And inside that, after the exchange is opened, and then the sale closes, then we monitor those timeframes and help our clients so they understand that they have whatever the 45th day falls on, like say it's August 15th, then they understand by August 15th, they have to go through this process of actually on a sheet of paper that we provide, identifying the property or properties they're going to buy and have that submitted by the 45th day, by midnight of the 45th day. Okay, so that's the process of the exchange. So now what I wanted to talk about, oops, the last slide is not there. So let's talk about a reverse exchange and the build to suit. Now, these two exchanges are the most complicated exchange in the code. Reverse exchange is an extremely complicated exchange. And I spent a whole class talking about these exchanges, so I'm not going to go into all the detail. I'm just going to give you just a 101, or excuse me, just a brief explanation of this. But the reverse exchange is a beautiful tool in this market. Because if you have a taxpayer that has the resources and they have a huge taxable event on what they're selling, and they can't stomach trying to find something in 45 days, and they're afraid of just throwing money against the wall just to save taxes, then the reverse could be a tool for them. So what it does is the reverse allows the taxpayer to buy their replacement property first. So when they can go into contract and say they have a 30-day, 45-day escrow. In that 45 days, if they can sell what they have to sell, and if it can close even one day before, day 44, then that would be a concurrent exchange that would be forward and they don't even have to do the reverse. But in the event that they found the perfect replacement property, but they have tenants that needed, some time to get out and they couldn't coordinate everything perfectly so that they found the perfect property and they don't want to wait. So if they have the resources and they can buy, then they go ahead and move forward, no contingencies. And then they use their cash to purchase. And then at the close of that transaction, they have a total of 180 days to sell what they have to sell. And then those proceeds come back to reimburse the taxpayer for wherever they got the money to buy or pay down loan debt. Maybe they had a higher loan than they would have had, or maybe they wouldn't have had a loan if they would have sold first. So we make everything right in the end. But the structure of this exchange is what makes it, is where the complexity comes in. Because if you bought something, now you own it, and you sell something, you have real estate you own that you want to sell, you own both at the same time. IRS says you cannot do an exchange on property you own. So what happens is before escrow closes on what they're buying, we create a shell corporation, a C Corp. An S Corp, not a C Corp. And that corporation is what IRS calls an exchange accommodation title holder, EAT, EAT is the acronym. And the purpose of the life of this EAT is for parking one of the properties, what they're selling or buying. Because if we can if they're buying with cash and there's no financing, we're going to take the property they're buying and we're going to deed it at the close of escrow to that corporation. If they're buying with financing at the close of escrow, if they're buying with financing, then we're going to come over here and take the property they're selling and we're going to deed that to the corporation. And we need that done like 2 days before escrow closes on what they're buying. So once that's deeded, they don't own both properties at the same time. So we just circumvented that issue that they cannot do an exchange on what they own. And then IRS per the code, what we would do now is when the property sells, then those proceeds go to the corporation. Now the corporation gets instruction from the taxpayer. And then the taxpayer will be reimbursed back their money so that they can that's where the tax deferral comes in. And they don't have to pay taxes on those proceeds that come back to reimburse them. And what makes that property, that type of exchange, valuable to some people, and they want to do this, are the following. A, it's pretty much a guarantee of a successful exchange, especially in a market like what we've been experiencing. They're not out there trying to find something, having a lot of money to spend and worried that they won't find it. It's pretty much successfully assures them that they're going to find the property that they want, not something they just have to buy. The next thing, though, with the reverse is it allows the taxpayer the opportunity. So say they don't have all the resources, so maybe they pull money out of their primary residence or another investment property, and they use that money as cash for the purchase of this property. In the normal circumstance, that's not a reverse exchange. If you take money from one property to another property when it sells, you have to pay taxes on that gain, on that money to pay off, the loan that you just got on that house. In a reverse, you can take those proceeds and pay off that loan on the primary or another property that they have, and that's all part of the structure of the deferral of the taxes and the reverse exchange. So it is a lot more conducive to being creative in regards to where to find money to buy. So when it comes to a reverse, it's just nice to understand that there's options and that they can, if they have the resources, that this could be an option that they can use. Now, another exchange that slide showed, there's a question that popped up. Let me make sure let me see if it's pertinent to what we just talked about. Okay, so question is, one question is, can a seller sell multiple properties and purchase one replacement property? Yes. So this, with an exchange, is beautiful because it lets you reorganize what you have. So for example, somebody may have, I just have a client right now that has several properties all over the US in different places like Kansas, Nashville, whatnot. And they want to sell these several properties and buy one replacement property. You absolutely can do that. But what you need to understand is with the timing, the 45 and 180, it's the first property that closes escrow will start the clock for the whole transaction. So if you're selling 4 properties, the first property that closes escrow will start that 45, 180 days, which will make it difficult. You would have to, try real hard to find that replacement property, try to get the other property sold, and it can be really grueling to make this all work together. So a lot of times I sit down with the client and strategize, and we figure out a good game plan, maybe a plan A and a plan B, so we can figure out how this can happen. What we do, and we just talked about a reverse, is when you're selling multiple properties, sometimes we do what we refer to as a hybrid exchange. And that is, if you're selling 4 properties, let's say, to buy one, maybe property 1 and 2 have sold and you can close them, but 3 and 4 are not moving like you had anticipated. So you're out there looking already for a replacement property, you found one. So now 1 and 2 will give you enough money as a down payment to buy the replacement property. So we'll go ahead and do a forward exchange on those first 2, even though you want to sell 4 altogether. Then at the close of the purchase, you have 180 days, because now we're going to set up a reverse for the last 2 properties. So now you have another 180 days to sell those last 2 properties and use that cash to pay down loan or pay off loans, replenish your cash personal. So now you get 180 days more to sell those last 2 properties. So with these combination of exchanges, a forward and a reverse, which would create a hybrid, you're able to accomplish everything you want to do with selling those multiple properties. So it's all about strategy. The next question is there any paperwork or agreement from you to the seller prior to the acceptance of the offer? No. We officially become involved in the transaction once escrow is opened, and that's when we officially start creating our agreements, our exchange agreement. Before that happens, it's just the time for education for the client. So that's where I really want to work with the client, help understand what they want to do, help map out, help strategize with them, help cheer both of you on, you representing the client and the client being there for you too as a listing agent. So there's no official agreement, but there's just, at that time, it's the time to answer all the questions and make sure everything's done. Everything will be done properly for the client. Now, the next question is, can a reverse exchange be used to increase the 180-day time frame to complete the exchange? No. So the only way there's more time added is if you do a hybrid and you continue on after. So maybe that's what you're talking about. So a reverse exchange can only happen if the purchase has to be bought before the sale can close. So if that happens and you can't get the sale property listed and sold, and they already found the replacement property and they have the resources to buy, that's what's going to trigger the reverse exchange. So it's all about what has to close first will determine the type of exchange the client needs to use. So we buy a reverse if we have just one purchase and one sale. A reverse exchange, we're just stuck to that 180-day time frame. There's nothing more. There's no way of manipulating or trying to use that to have a longer time frame. The only way you can manipulate things to make it a longer time frame, say you got new construction, you want to buy, well, this is wouldn't be a reverse. Bad example, but let's just use a forward exchange and you have new construction. And 180 days would be December 31st. That would be 180 days. And you've been told by the developer that your property won't be completed till till February, let's just say. So you would delay listing the sale property, you go into contract on the purchase property, and you're in contract for a couple months before you actually sell. Now you just, add, now when the escrow closes on what you're selling, that 180 days may be March. So you have time now to close. So I hope if I didn't answer that question, you can rephrase it in the chat room and I'll answer if I didn't answer that properly. Okay, so can I reverse? So the reverse exchange eliminates the 45 days to find the property. Darush, that is absolutely correct. The 45-day identification is different on a reverse because you're going to identify what you're selling. And most people know what they need to sell. So the stress on finding that replacement property, getting something identified and hoping you can buy it, that stress is gone. So you pretty much know what you're going to sell. Some people have maybe two properties and they don't know which one they want to sell. They just would like to list them both. We can park both of those properties in the corporation that we create and they eat. And maybe they only need to sell one. So in the end, when the exchange is done, we just deed the property back to the client. Other times they put two in there hoping both sell, but maybe one does sell and one doesn't. Again, we would just take one property and deed it back when the exchange is done. So the good news is the reverse does take away the stress of the 45-day identification. Okay, so we've talked about, oh, thank you. Thank you very much. We talked about the reverse exchange. We talked about the simultaneous exchange, the delayed exchange, and there's one more exchange that I want to talk about, and that's called the improvement or build to suit. And basically, what happens on this exchange is it only works when you buy with cash. If you have a loan in this transaction, it will not work unless it's private financing or swing loan, something like that. And the reason being is when you do a 1031 exchange, and escrow closes on what you buy, that ends the exchange. So if there's money left in the exchange account, that becomes taxable, or the term boot. So to circumvent that, this build-to-suit exchange per the tax code, what happens is when escrow closes on the purchase, we create a shell corporation again, and that property is deeded, the purchase property is deeded, not to the taxpayer, because it would close the transaction, to that shell corporation that we create. Now, what's happening is the money left in the exchange account, say we have 100,000 left, is not taxable, and that money can be used to improve the property that they're bought. So what makes this difficult is they have the sale escrow, the time frame, the clock from the sale escrow, the 180 days and the 45 days that's what they have to work with. So you want to make sure that the purchase and the sale, if it's possible, can those close simultaneous? And if you can do that, then you have a whole 180 days for the improvements. If there's not a lot of improvements to be made, then you may not need to do that. But just know that the time frame starts for these improvements at the close of the sale. So my example, let's say we close simultaneous, the sale and the purchase. Now, we've got 180 days and 45 days to identify now, not only what we're buying, but we're going to identify what improvements we're going to use to spend that 100,000. So say I'm going to put kitchen improvements, whatever that may be, maybe that's 70,000. Then I got a bathroom, 2 bathrooms, maybe that's 30,000. So we got some improvements with some dollar values. So you add that all together, the purchase of the property, 400, these improvements, and all together, that's 500,000. And I bought for 400, so that allows those last 100,000 is the improvements to be made. I'm sorry if I'm repeating that, but so what happens is now with your contractor and your vendors, we, because the property is owned by this corporation, that corporation is going to be the taxpayer that's going to be paying for those improvements. So you send us the contractor's bill, you read and approve, and you allow us to pay through your exchange funds, whatever that bill may be. Vendors, same thing, you read and approve, you sign off, you send it to us, you let us know that it's okay to pay, then we'll pay these vendors. And we keep doing this process on work that's legitimately being done on the property until the money's spent. When the money is spent and there's no money left, either the 180th day comes or the money is totally spent, then we deed the property back to the taxpayer and the exchange is done. So if we go a whole 180 days and say there's $30,000 left in the account, then they still have a beautiful exchange. They just pay taxes on the 30K, we release that, and we deed the property back to them. So they still had tax saving dollars, they just didn't spend all their money. So it's still a win-win at the end of the day. So the improvement exchange is something that may or may not be of value, as much value these days, because there are some tax benefits. It's called immediate expensing on the property you're buying, and you can write off immediately any improvements. So it's really a good conversation to have with your tax professional if a bill to suit is a good tool versus what we would say there's 30,000 left over and they wanted to use that for improvements. We have to legally say that 30,000 is a taxable event because it is. It's boot in the exchange. But now you go to your tax person, and if you get that immediate expensing for the improvements you made with that 30K, it may be a wash at the end of the day. So it's very important to perhaps have a good conversation, your client to have a good conversation with their tax person so that they understand what would be the best educated decision for them. Okay, so we talked about all these different types of exchanges, and we talked about timeframes. So just as a recap, we have exchanges are for properties that are rental properties and properties used for the productive use of a trade or a business. So the like kind that we hear in the code has nothing to do with, you can't sell commercial and buy a single family investment. So it has nothing to do with what the type of the property is and everything to do with how it's used. So investment for investment is what is important. So you can't sell investment property and buy a primary. That does not qualify. The next thing we talked about is our listing appointment. What are things to look for on the listing appointment? For example, are they talking about exchanging? Is investment property? So if not, ask them, what are you going to do with these proceeds? If they say I'm going to buy more investment property, then hands down, they need an exchange. If they say, you know what, I'd rather pay the tax, send them to their tax person. So that not doing an exchange is fine. We just don't want the person to be shocked and angry later at a tax bill that they may not have had to pay. So you just want them to go to their tax person and get an educated decision in regards to what they should do with those regarding those taxes. The next thing we talked about is what do they need to buy for? basically it's equal or greater to that net sales price. That's as low as they can go without a taxable event, and they can buy as high as they can afford, especially if they use the 3-property rule identification. They can just buy as high as they can afford. So now, remember, what is the net sales price? That's the sales price minus the cost of sale, which is the non-recurring closing costs, which is escrow, commission, title, recording fees, inspections. So you had a termite report that came back with a lot of work. So that work as a result of the inspection, those are non-recurring. So those fees can be deducted out. And then the net, whatever that sales price is after deducting those fees, that's as low as they can go. But if somebody's going to buy higher, then we don't have to worry about doing all that math. They just buy greater than what they sold for. So, but doing all that math, if they're trying to figure out as low as they can go, then it's really important to do that math. So they have to buy equal or greater to that net sales price. So now the net sales price may include a loan. So remember my example, I sold for $500 after fees. I have a $200,000 loan and $300,000 cash proceeds. So I don't buy for $300 because I'd be paying taxes on $200,000 loan that I didn't replace. So loan debt must be replaced. And there's 2 ways of replacing it: by getting another loan, and that loan can be anything from conventional to private money to, swing loans, whatever it is. They can do any way of providing a loan that works, or they can bring in their own money to replace that loan debt. So remember, loan debt must be replaced one way or another. So we buy equal or greater, get a new loan, use my cash. That is a totally deferred exchange. Some people may want to do an exchange and they want money. So we call that a partial exchange. They tell us the dollar amount they want. Maybe they want to pay taxes on $50K so they can have money for the kids for college or whatever they're paying bills, whatever they want to do. So we call that a partial exchange. And we tell escrow in our agreement, our exchange agreement, to release $50K at the close of escrow, the sale escrow, to the taxpayer. And that money will not be included in the exchange. And then the remainder of the proceeds are used for the 1031 exchange. And they just pay taxes on that. 3 1/3 withholding comes out of that, and they can have that money. So they can do something called a partial. Now, remember an exchange as a recap. I want to do a little recap, finish that, and then we're going to talk about some of this going on with Biden. We're going to talk about that in a few minutes. So now when it comes to 1031 exchange, remember they can sell one property to buy one, or sell one to buy multiple properties. And it's the cumulative value of what they buy that adds up equal or greater to what they sold. If they want to sell several properties to buy one, they totally can do that. And it's the cumulative value of what they sold that needs to be equal or greater to what they buy. So they can go either direction. Now, I've got another question. It says, example, sell property tax base $100K, net of cost $500, buy a new property for $1 million. Is the new cost basis $600,000? Yes, let's see, the base tax basis was 100, net cost, yes, exactly. The new tax basis is 600. There you go. Okay, so now in relation to, so we talked about what we can do with that. We talked about the different exchanges, the different tools that are in the exchange world. For example, we've got the forward exchange with the regular timeframes. We have simultaneous where everything can close together, day apart, whatever it may be. They have the improvement exchange, the reverse exchange. And in this market, the reverse exchange has been a very valuable tool for the right person. It's not the right thing for everybody. So now we have that. So if there's no other questions, I think we covered all the categories about the exchanges. I think the most important thing, if I were to wrap everything up before we talk about the new tax reform, is make sure all the questions up front, use the upfront time before listing, during the listing period, make sure the client, if you want me to help your client make sure you just contact me. You can call me direct, you can email. I'll be happy to talk to your client. Even if they don't need an exchange, I'd love to hear their story so I can tell them. I'm the first person, literally the first person that will tell them not to exchange if it doesn't make sense to what I'm hearing. But I will never settle on that. I want them to talk to their tax professional to find out if that's really true. But we want to make sure that whatever they do, exchange or not exchange, that they make an educated decision. And that time up front gives us time to make those decisions and not be a fire drill. Because if they go into a fire drill and they try to do an exchange and they find out at the last minute, then there's a potential that there's a lot of information that they needed to make good decisions they didn't have. So they may not have made the best decision. I'm asked to give me my contact information. So let me see if this comes up on this slide here. Oh, my slide didn't show up. Okay, so my email address, so my name's Debbie Bannister. My email address is dbannister, and it's spelled B as in boy, ANNISTER, dbannister, at, and that the name of my company, exchangeresources.net. So it's dbannister at exchangeresources.net. And my cell, my work cell, which is probably the best number, especially with COVID, is 714-269-1285. 269-1285. There we go. And then D Bannister. I'm going to put that here. Okay. I think I spelled that right. So let's just see. D Bannister at exchangeresources.net. Okay, so now I wanted to take just the last few minutes of our class. We have a few minutes left. And I want to talk about, there's some potential, there's the American Family Plan that the Biden administration is working on has some changes that they want to make to the tax code. So, oops, I'll do that. So I'm going to type in here, and you're welcome to email me. Thank you. You're welcome to email me and also ask for this information. But let me put this down. I'm going to put this web thing down. We want www.1031 tax. Okay, this is very important. Let's see here. I think we did it. Okay, so we're going to talk about this act, and it's posing a very serious threat to the 1031 exchange. We have had this fight for many administrations. Obama administration, they wanted to cap the 1031 exchange with any gain to $1 million of people qualifying for exchanges of gain, and any gain after $1 million, they just had to pay tax on. The next administration, the Trump administration, they wanted to get rid of exchanges completely. This administration now, they want to cap the ability to do exchanges up to 500K. So any gain after 500,000, they pay taxes on. So let me explain. Last administration, we had some macro studies of the economy as a defense for the 1031 exchange, because it was perceived by Congress and the tax commissioner that the 1031 exchange was was like a funnel of the government losing money, because so many people are utilizing this tax shelter, and the government was losing. They had some erroneous figures. They thought that we were losing millions and billions of dollars because of the 1031 exchange. So they did these micro and macro studies by Ernst & Young and Petrolovich, these different companies that did these micro macro studies that are used by Congress and the Treasury Department and whatnot. And they found out, as a result of those studies in the last administration, that the exchange not only did not lose the government money, but it made money for the government because of it's all about the sale of real estate, which is what we do. As you guys know, when a property is sold, how many services are involved? How many people get paychecks are involved in different services in the sale of real estate? So we have auxiliary services like the exchange, we have, stagers, we have cleaners, landscapers, we have construction people, termite companies, inspection companies. There's all these different businesses that rely on a real estate transaction for their livelihood. So they found out that because of that, they were getting taxes in so many other different fashions that totally overshadowed the gain they had, overshadowed the loss they interpreted they were having with the exchange. So those studies, because of those studies, we beat that tax reform with the Trump administration, and we won. And 1031 was protected. There was no changes, and everything was great. Now we're in this administration, and we're starting the battle all over again, and we're exhausted. I'm so exhausted about this. Yes, I'll do that. So I'll talk about our fees after I talk about this. So what's happening now is the proposal is that they want to get rid of the stepped up in basis, which would be horrible. They want to limit the tax 1031 exchange. The max would be up to 500K. So any gain after that, they pay taxes on it, or there's even talk of eliminating the exchange. But what they found out in these macro studies that were updated now for this new administration that happened in the last administration, they found out that the GDP is estimated, if they got rid of the exchange or capped it, would fall by 8.1 billion a year. Investment is estimated to fall by 7 billion each year. Labor income is estimated to fall by 1.4 billion a year. So the estimation reduction, if they got rid of exchanges over 10 years, they would lose between 61 to 131 billion dollars by getting rid of the exchange. So that loss is huge. So I typed in the line in the chat room. There's a website that's been created that for the 1031 exchange. If you go there, it's called www.1031taxreform.com. So it's 1031taxreform.com. You can go there and you can send to Congress an electronic letter that will be created in this website browser that defends the 1031. So I just wanted to put that in there so that you have that information. Okay. So, as an industry, we're not too afraid because the studies are totally in our favor. But to be honest with you, anymore these days, even if something seems logical, what's not logical sometimes happens. So we really can't be relaxed. We just need to do the best we can to try to fight this battle again. So I brought that up. So now I had a question regarding the fees for our services. For us as a qualified intermediary to help a client with one sale, one purchase, it's a flat fee with no extra fees whatsoever of $950. If the transaction is over $3 million, then we charge $1,200. It's a flat fee. That's for the sale and the purchase together. Any additional properties added to an exchange, so if they're selling more than one or buying more than one, then each additional property is only $250 for any additional property to the exchange. The reverse exchange is the most, and build-to-suit are the most expensive exchanges out there. They're the most complicated exchanges in the code. We create corporations. There's all this legal work that's done. So the reverse is $8,000 to put that together. And the build-to-suit, we give quotes. It could be as low as 8,000, could be as high as 10. We give quotes on how much work is involved. So we'd have to know the circumstance. But for a traditional out the door, $950, pretty basic fee. So you don't have to worry about anything else. And all the exchange fees are tax deductions. They're an allowable use of the exchange funds. So it doesn't have to be money out of the pocket too. Okay, so it says, would it be a benefit to our client that the appreciated property to do an exchange to avoid paying taxes on appreciated. Would it be a benefit to our client that have appreciated property to do an exchange to avoid paying estate taxes? Well, it's not going to avoid state taxes on appreciated property by using stepped up in basis. So what happens is that in a 1031 exchange, there's certain scenarios that may not benefit. So somebody inherited the property and they have that stepped up in basis, then they don't need to do an exchange unless the value grew, unless they held that property and now the value's grown. So now they're going to do an exchange on the value that the appreciation that happened after they inherited the property. But an 1031 exchange does not help or diminish or replace estate taxes. Estate taxes have to be paid. If they're owed, an exchange cannot be used as a tool to circumvent paying that. Okay, so I hope that makes sense. You're welcome. It's my pleasure to answer all your questions. So are there any other questions that you guys may have? It's been my pleasure that I've been able to talk to you. I hope that I made sense. There's a lot to talk about, so I hope I made sense. And if you guys have any questions or have clients that need help or just wondering if an exchange is of value, you're welcome to call me and email me, whatever your best mode of communication is. And it'd be my pleasure to answer those questions and help direct your client in the right way. And you're so welcome. It totally was my pleasure to be with you guys today. And I sincerely hope everybody has a great day. And thank you for buying out time to be with us today. Okay, see you later.